All right, in 19.2, we're going to determine the cost of merchandise inventory. And most businesses use one of three inventory costing methods. The first one is the first in, first out method, costing method. It's also called FIFO. So we have the total units on hand. That's usually given to you, okay? And then we do the units from the most recent purchases because first in is the first out. So we're going to assume that the purchases from January are going to be out, February are going to be out, and April are going to be out. We're going to use the inventory from the last ones because the first that comes in goes out. So units needed to equal the total units on hand. So we're just going to go back however many months or purchases to equal this number. So in this case, we need to account for November 22nd purchases of 8. And then we need to go back another month to make up the rest of the 18. So that would be the September purchases of 12. Then you put in the, you go ahead and multiply out the unit price times the FIFO units. And then you have your total FIFO cost. And again, FIFO stands for first in, first out. All of these are inventory costing methods. Okay, the second type that businesses use is the last in, first out inventory costing method. This is called LIFO. This method is based on the idea that most recent costs of merchandise should be charged against current revenue. So using the LIFO method, each item on the inventory records is recorded at the earliest prices paid for the merchandise. Okay, so we would do our total units on hand is 18, but instead of doing the last ones that came in, okay, we're going to assume these are the first ones that came in because we're selling the last. The last in is the first ones that we're selling. Last in, first out. It's kind of confusing, I know. Okay, so we have our beginning inventory units. So we would start from the very first ones we purchased. Okay, we're going to assume that these 18 are from the very first 18 we purchased. So we have 10 from January. Then units from earliest purchase, we have 6 more from February. But we needed total units on hand. So we need, this only adds up, January and February only adds up to 16. So we need to go another purchase. Well, the next purchase, we purchased 14 in April. But we only need 2 more to make up 18. So we're just going to put 2 here because we have 2 left from the 14 that we purchased in April. So 10, 6, and 2 add up to 18. So we're going to multiply our 10 times 1880 is 188. 6 times 1960, the unit price is 117.60. And then 2 times 2040 is our 4080. Okay, so that's what we've just done. We multiplied those out. Then we do the total LIFO cost. So in the LIFO method, the latest purchases are assumed to be sold first because they're the first out. Therefore, ending inventory consists of the units purchased the earliest, and the earliest purchase invoice costs are used to value that ending inventory. Okay, so the third method is the weighted average inventory costing method. This is when the average unit price of the total inventory available is calculated. So we have the total cost of inventory available, which is $1,020. We have the weighted average price per unit, okay? And we got this number by dividing our total cost divided by our total units. So that gives us $20.40. Then we do our cost of ending inventory. So we have our $20.40. We had 18 units in ending inventory, so we multiply that out to get $367.20. So this is the weighted average. So a business usually determines the order in which products are sold based on the type of inventory. So a grocery store, for example, must sell its earliest purchases first because it's going to expire. You know, your food expires. So you want to purchase, the stuff you purchase first is going to be the first to go out. A hardware store, however, could sell its most recent purchases first. So the inventory costing method used to calculate the cost of merchandise sold should not, however, be determined by the order in which items are sold. A business should choose the inventory costing method that provides its managers with the best accounting method. And you should not switch it. Once you decide on one, you shouldn't switch it. So calculating the cost of merchandise sold is pretty simple. You take the cost of merchandise available for sale, and then you subtract out your cost of ending inventory. So FIFO, it would be $386, and that equals your merchandise, cost of merchandise sold. Now in comparing these, we've got our FIFO column, our LIFO, and our weighted average. And so the cost of merchandise sold in FIFO is $634. The cost of merchandise sold in LIFO is $673.60. And then the weighted average is $652.80. So in a period of rising prices, the relative cost of ending inventory is highest in FIFO, lowest in LIFO, and intermediate is the weighted, okay, because it's taking the average. And the relative cost of merchandise sold in a period of rising prices is lowest in FIFO, highest in LIFO, and the weighted average is intermediate. So like I said, all three inventory costing methods are acceptable accounting practices, but a business needs to select one method and use that same method continuously for each fiscal period. Because if a business changed inventory costing methods, part of the difference in gross profit and net income would be caused by the change in methods. All right, so let's do 19.2 work together. So let's go to our APLEA and open up Chapter 19.2, work together on your own. The instructions for this are on page 573 of your textbook, or you can also find them right here. So we're going to determine the cost of inventory using the FIFO, LIFO, and weighted average inventory costing methods. We're going to calculate the cost of ending inventory based on 16 units. Okay, we have 16 units in ending inventory. Okay, so I've already put this 16 here for the FIFO. We're going to start with FIFO. And FIFO is our, let's just open up our notes. It's the first in, first out. So we're going to use our last purchases first. Okay, so 16, we purchased 9 here, so 9, and we know that cost is $342 because 9 times 38 is $342, but we still need 7 more. So we're going to come up here, and we have 8, but we only need 7 more, so we're going to put in 7, and 7 times 36, do I have a calculator here? Find the calculator right here. So 7 times 36 equals $252. And then we're going to add 252 plus 342. So 252 plus 342 gives us a total of $594. Okay, so that's the FIFO method basically. First in, first ones we bought are the first ones that sell. Okay, so now we're going to go to the LIFO method, and again, I already put 16 here. That's our units on hand. And this one, the last in is being sold first. So we're not going to count these because we're going to assume that they've been sold. So 16, we're going to go way up here. We had 14 in January, so we're going to go ahead and take all those 14. 14 times 30, we already know is 420. So let's put 420. Oops. And then we're going to need 2 more. 16 minus 14 is 2 more. So we need to go into March. We had 9 purchases, but we only need 2 of those because we're assuming 7 have already been sold. So 2 times 32 is going to be $64. And then we need to add those. So 420 plus 64 is going to give you $484. And that's what we get doing the LIFO method. You'll see this cost is much less than this. Okay, that's probably because prices were rising. Okay, so as the year went on, prices rose. You can see they started at $30 a unit price, and by the end of the year they were up to $38. So this amount, first in, first out, is going to leave us with a higher amount. Okay, whereas the LIFO, the first ones that we bought are the ones that we account for, then it's going to be a smaller cost because prices again are rising, but we're calculating our totals based on what we purchased in January and March when the prices were cheaper. Okay, so the weighted average, and I'm just going to turn to my notes so that we know what we're doing. Okay, so we have 16 on hand. So we're just going to first calculate our prices, okay? So that we can average them out. So 14 times 30 is 420. 9 times 32 is 288. 10 times 34 is 340. 8 times 36 is 288. And then finally 9 times 38 is 342. So the total of this is going to be 420 plus 288 plus 340 plus 288 plus 342. So our total here is our $1,678. So now we can calculate our weighted average. So the total cost of beginning inventory and purchases, that is this number. That's total cost for the whole year. And that is $1,678. We're going to divide that by our total units. So that's 50. And what are we going to get? Let's just go look. Where's my calculator? So divide that amount divided by 50 is going to give us 33.56. All right, but it says in our ending inventory we have 16. So 16 times, and our weighted average price per unit is $33.56, and that's going to equal our cost of ending inventory. So $33.56 times 16 gives us a total, the cost of ending inventory total is $536.96. Okay, so we have done our FIFO method, our LIFO method, and our weighted average method. And you'll see in an economy when prices are rising, okay, January they were 30, November they were 38. So in an economy where prices are rising, which is, our economy for the most part, in the first in, first out, your cost of ending inventory is more because you're taking the, you're multiplying times the higher prices. In the last in, first out, the LIFO method, you're calculating your cost of ending inventory by earlier prices, so it's cheaper. And then obviously the weighted is going to be in between here because we're taking the average, so that's $536.96. Okay, so what I want you guys to do is go ahead and do the On Your Own 19.2 and the application 19.2.